Okay, hello everybody. Welcome to Korean Atlanta Mentorship. We're going to talk about velocity banking again for today. But before we get started, I just wanted to talk about this little advertisement. I don't know if you've ever seen it. It's Family Guy's parody of Chase Bank. So just type in Family Guy Chase Bank on YouTube, and it's really hilarious because one of the things that you'll notice about bank marketing is that they pretty much lie to you directly in your face about how they work, right? And Family Guy does a great job of parodying that. And so one of the things that most people don't understand is that because they get tricked by bank marketing and internalize it, they think that the bank is actually going to be there for them when they're based on their financial needs. And I used to think that way too. And I think the reason why I used to think that way is just because of the concept of student loans, because that's really need based. But the reason why student loans can be need based is because they're government guaranteed. So the risk that they would normally assess is not actually there. Whereas with all other loans, debts, credit products, it's risk assessment. And one of the things that we have to understand is that we have to understand how to get the credit products when we need it, how to master them, and what the bank's agenda is in order to make as much money as possible. Now, why would they lie to you? Okay, why would they lie to you how they work? And first of all, let's start off with this. Um, the way that a bank works is that they don't lend money to people who need it. Now, this is most people don't know this. Most people don't know this, and this is why I repeat this in every single video. Because what happens with a lot of people is they get into financial issues, hardships, and they've internalized the bank marketing about, well, they said they were going to be there for me, so how do I get a line of credit? And the answer is that you don't get a line of credit when you need it, right? It's all about um, for the bank risk management. And so the other type of industry that's heavily into risk management is insurance, but they don't tell you stuff like, hey, we're going to be there for you if you don't get insurance and you crash your car, right? But that's how a lot of consumers think when it comes to banking, because I think the bank advertisements are so focused on, we're going to be there for you. We're going to be there when you buy your first home. And again, 90% of people in this country don't even qualify for a mortgage. So that kind of messaging, community support, really puts people to sleep. So it's kind of like a wolf in sheep's clothing. And think about this: if the bank were to tell you, "Hey, like we're here to just kind of do nothing and make money off of you," how many people would be actively more engaged in finances? It's like, well, I don't want to deal with the institution, or I don't want to get screwed over by an institution that is just there to profit off of me and do nothing, right? So there's a reason why the bank doesn't tell you how it actually operates. Because if more people are aware, then they understand the game, then most people won't make, like, the bank won't make as much money compared to just being a wolf in sheep's clothing and lying to you, right? And you can ask ChatGPT this as well. I just asked ChatGPT, do most people understand that banks don't lend money to people who need it? And it says, not really, not really. Oh yeah, yeah, the average person doesn't understand. And let's go ahead and play the answer.
Not really. Many people assume banks lend based on financial need, when in fact, banks are typically looking for creditworthy borrowers who don't need the loan in a desperate sense. Banks lend to individuals or businesses that demonstrate a reliable ability to repay, usually verified through credit scores, income stability, and collateral. This is why banks are often more willing to extend loans to those with good credit or strong assets. The misconception persists partly because banks position themselves as supportive institutions. However, the reality is that lending is about minimizing risk for the bank. So the best candidates often look like they're financially stable and don't urgently need the funds.
And then I also asked, why does their marketing contradict reality? So let's go ahead and play this.
Banks' marketing often contradicts reality because their ads aim to create an image of being supportive approachable, and eager to help people achieve their dreams. They focus on the aspirational side of borrowing, emphasizing buying a first home, starting a business, or going to college. This portrayal aligns with what many people want to believe about banks, that they're there to help them achieve big goals. However, in reality, banks prioritize managing their risk, which is why they lend to people with the best financial standing. The reassuring image in marketing can make banks seem friendlier and more flexible than they are in practice. By appearing to care about helping people in need, they attract a wider customer base, even if their actual policies are far more selective.
Right. Right. So now you understand the game, right? Go to ChatGPT and ask about this. Memorize this. Say this to yourself over and over again because what happens with a lot of people, right? And I'm going to tell you who the bank's best customer is someone who makes money and is a little bit bad at managing it. And the best way that you can actually understand this is think about like if you were to run a pharmaceutical company, who do you want to sell pills to? Do you want to sell pills to someone who's going to die tomorrow? No, because how do you make money? You need to sell pills. That's the way that banks see poor people too. So if you see here, like, hey, their marketing just is kind of lying to you about how we're there for you, but they don't want to deal with poor people. That's what the check cashing places are for, where that charge like this insane amount of interest because they're a huge risk to normal banking institutions. Okay, so but at the same time, they don't want to deal with people who are super good with money, right? Because that presents them a big risk as well. Like if you got a 30-year mortgage at 6%, that's 115% return over 30 years, right? So if you're dealing with mortgages, you don't want to pay it off in 1 to 5 years, right? Because now you've significantly cut your return on your low, what should be a relatively low risk investment, which is your loan. Okay, so so that's like the person who is like, I'm gonna go eat organic only, go to shop at Whole Foods, Sprouts, Mother's Organic Market. I only eat there and I love Mother Nature, and I'm never going to take a pill in my life. That's actually a risk to the bank, right? So the sweet spot for who they want as their best demographic and client base is people who make money, someone who makes decent money like this, but is kind of bad at managing it, right? So think in terms of health, like if you're a pharmaceutical company, who would fit in that category of like, yeah, you're kind of healthy, but you're kind of dumb about maintaining your health? The answer to that is children. And that's why a lot of pharmaceutical companies target children because they're like the prime demographic of people who they can sell pills to for the rest of their lives. I know this sounds kind of harsh, but that's the reality. Look, I didn't even make this up. Like I just know this because I listened to health podcasts throughout the years, and I was like, "Whoa, that's pretty sinister." You know what I mean? But it's the same thing with banking. Now, the thing about banking is that they're just making money off of your poor choices with finances, even though you make money, right? And the biggest reason why a lot of people, even though they take on debt, can't pay it off is because their income is segregated. So, what does income segregation mean? Is that let's say you make income and you have all this debt, right? So, how many debts do we have here? We have one, two, three, four, five, six debts. So your paycheck comes in, it gets split into six places, and rather than splitting your money into six places and putting the leftover in savings, because the reason why you got a savings account is because that's the responsible thing to do, 3 to 6 months of savings. What we're going to do is we don't need to make more income. We make the same income, but we're going to have zero savings. And what velocity banking emphasizes is that we're going to use a line of credit to give us the ultimate flexibility in having zero savings. Because what happens when, let's say, we directly put that $7,000 into an auto loan, student loan, or a credit card? Like, if I put all my money, like $7,000 into a credit card, I can't Well, I can technically use the money, but it's a little bit hard. Like I can't pay my credit card's bills with the credit card. I can't pay my auto loan bill with the credit card. That's why we tend to use personal or home equity lines of credit. But the main important thing that we want to emphasize is that we're just not going to have any savings and we're not going to segregate our income. In fact, I actually did a live stream on this like a couple months ago where somebody had sent me their finances and their spreadsheet, and there was 22 debts and $4 left in savings. I was just blown away. That was like the ultimate example of segregation of income. So if you want to see that live stream, it's under a 99-cent YouTube membership. Go ahead and join that, and you can actually see that. I don't, here I always just go over the basics, but in the live streams, I kind of go a little bit deeper into other topics. But yeah, so this is this is where a lot of people like don't understand why they get screwed over. And so even if you were able to get a line of credit, right, at this situation, most people would still segregate their income. And the likelihood of you getting a line of credit at this stage where, your DTI ratios are really high is quite unlikely. No one's going to give you a line of credit because that's not how the bank works, right? What they want you to do is get a bunch of debt and then just make sure it's segregated, and then you're essentially making minimum payments on everything. And the fact that you have a savings account is essentially ensuring that these loans won't be paid off quickly, and we use a line of credit to help us with that, right? So let's go ahead and get started. Remember, the right mindset, that we need to get credit products and a line of credit before we ever need it. And it's actually in your best favor to learn velocity banking before you even take on debt. It actually is. I actually learned this stuff when I was making 20 grand a year. And now I have over $527,000 in lines of credit, right? Because I internalized, like, at first I was like, why would I need to know this if nobody's going to give me a mortgage, right? And then once I got the mortgage, I was like 25% gone in under 1 year, and I was like, whoa, that's amazing. Okay, that's mind effing mind blowing amazing. Okay, so that's why like I understand the value of learning this before even at a low, you let's say you work at McDonald's and or whatever minimum wage, learn this stuff, practice the spreadsheets, do it over and over again, internalize the mindset. Because what happens with a lot of people is that they'll say something like, well, I got out of debt and I got back into it again. Just because you didn't internalize the mindset needed for success. And not only that, understand the mindset of the people who are essentially taking advantage of you, right? They don't want to know how to they don't want to let you know how to win because they're just constantly lying to you and putting you to sleep, right? Remember that quote by George Carlin was like, it's the American dream because you got to be asleep to believe it. Think about home ownership. Do you think most people understand that home ownership, like, if I buy a $200,000 house for at a 6% interest rate, that's actually a 300 and I don't know 350 or something $1,000. No, actually, let me just do this right now. Bank rate loan amortization, because now I'm just curious. HBSC mortgage, and let's just quickly go through this. $300,000, actually $200,000 loan at 6%. How much interest am I paying? What's the total cost of the loan? 431,000. So do you think the average American is aware that if they get a $200,000 loan, that it's gonna the true cost of what they're gonna pay is 431,000? Probably not, right? And they're gonna wonder like, hey, once I get some debt, oh, okay, I'll get a credit card here, a few loans, and then they'll get that sweet, sweet refinance letter 5 to 7 years and think, oh my goodness, the bank is doing me a favor because now I can refinance. And again, refinancing isn't always bad, right? But for if I'm going to spend all that marketing money to get you your refinancing, there has to be something in it for me, and most people don't think that because they internalize the bank marketing, which is that they're going to be there for them, right? So they just don't question it. Okay. All right, so let's go ahead and get to it. So, Velocity Banking Review, number, what is it? I think we're in video number 700 something. so, um, yeah, so what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. So, what that means is after the end of the month, you shouldn't have anything in your checking or savings account. You see this? Zero beginning, ending balance zero, and anything that comes into my checking account, it's all gone. It's all gone, right? So I'm not doing something stupid like saving $1,000 in the beginning emergency fund because as long as I got a line of credit, okay, as long as I got a line of credit, that's going to be my main operating account, and my savings, anything in my savings and checking is going to be zero. That's what this means, okay? So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. And as I said, I have over 500, I think $27,000 in lines of credit. And the more that I say it, the more I can't remember what my actual limit is because it's always increasing because I'm always getting the money before I need it. So that's the most important part. We got to get it before we need it. We have to understand where the bank wants you to be and why they wouldn't lend to you when you're in an emergency, right? They want you to feel like a little bit pinched, financially pinched from all the debt because you're making good money and you don't understand why you're broke. Okay, so here we go. Same expenses and then same. We're just going to copy these expenses. So step one is we got to create a budget, which we already did. Income, expenses, savings, and then we list every single debt that we have, right? And then what we do is we create the second column, which is the velocity banking column, right? And we emphasize the zero savings, but we have something called cash flow. Now, this isn't the final step yet because what we got to do is we got to move some of that debt into a line of credit. And like I said, this is just the most unrealistic part. What happens with a lot of people is if they do have a line of credit, is it's maxed up to the brim like these credit cards. But just to make the demonstrations easy, I always show that like you have a free line of credit. So this is kind of like, hey, if you had a lifeline, this is what it would be. But the bank gonna get the bank ain't gonna give you the lifeline. You know what I'm saying? So, all right. So let's go ahead and do this and we're going to move these debts, right? So to be 15 plus 27 plus 10. And then so that's $52,000 of credit card debt. We got the three credit cards of 52,000. Okay? And so now what happens with these credit cards when we move it into that line of credit, and again, we'll assume that we have an 8% $60,000 home equity line of credit. So think of it as like a huge credit card based on the value of your home, right? I have a $280,000 home equity line of credit. I always like to flex on the YouTube channel, but I'm a little bit too lazy to bring up the YouTube tab right now. But yes, $280,000. But we're going to assume we have a $60,000 home equity line of credit. So once we move that 52 grand in credit card debt, guess what happens, right? So these three credit cards turn to zero and the cash flow is now $2,471, right? So you see that? Because what we're going to do is instead of leaving some of our leftover money in savings and use our checking account to pay for things, we're going to put our entire paycheck into that line of credit. We're going to put the entire 7 grand into that line of credit. And then we're going to take our expenses out, which is 4,500. And then after every single month, the balance of our debt will go down by 2,471, or the balance of the line of credit. So when we pay 7,000, right, we pay 7,000 right here, and then we take our expenses out, which is 4,500, right, and then 2,400 after every single month, it's gonna reduce the balance. So let's go ahead and do this. All right, and then what we're gonna do is take the previous month's balance plus the previous month's interest minus 2471.14. And then what we're going to do is we're going to take this thing called the average daily balance. So let me just do that right here. Average, right? Multiply it by the interest rate. So 0.08. And you might be thinking, 4 grand, that's so much. Oh my goodness, that's a lot of interest for 1 month. No, no, no. It's 8% annually, but you got to divide it by 12 because the average is calculated monthly, right? So, or I'm sorry, the interest is calculated monthly. So you're actually paying $300, which is not bad. I mean, I mean, who wants to pay $300 of interest? Banks got to make a little bit of money, but I don't want to make have them make a lot of money, and then you just rinse and repeat the process. Paycheck in, expenses out, paycheck in, expenses out, over and over and over again. Right. Kind of like that. Was that Linkin Park song? I don't know. All right. So now, 23 months, it's been paid off. So we paid off this 23 grand here. So, or 23 months, we paid off, what was it? 52K, right? 52K, and then now we tackle on the auto loan, student loan, and the mortgage, right? So um, these debts actually the payments aren't really that high, right? But we want to still recover as much cash flow as possible. Reason why we tackle the credit cards first is that they have the highest interest rates, but they also suck up the most cash flow, right? And the whole name of the game is cash flow recovery. So what happens with a lot of people is not only they have credit cards, but they also have like these short-term loans. I've seen this before, and they're usually like 1 to 1.5 years, and those are cash flow sucking monsters as well. I want to get rid of those as well. In my examples, I just don't like to use them, although I know that they are a reality for a lot of people because believe it or not, these companies make a lot of money, and they're relatively new too. I mean, what's a company like Affirm? Affirm, right? The buy now, pay later. How much is their annual revenue? Well, let's check. All right, so 2.3 billion, 2.3 billion, right? So the annual revenue of those buy now, pay laters that you see on what's it called? Well, yeah, it's on their website and their financial earnings for their stockholders. 2.3 billion. So let me just tell you something, right? Like there's a lot of money spent to build an infrastructure just to make your credit card and these buy now pay laters work, right? A lot of people think it's like literally just free money. Oh, they're just there to help us. No, they're there to make money, right? I mean, I wrote in ChatGPT how much money does this do you have to spend to set up like a credit card, like to launch a credit card, like a new credit card? It said somewhere in like, oh, like at least 10 million, right? So they spend a lot of money so that they can get this money, right? so but a lot of people again they get tricked by the marketing, thinking like these people are my friends, they're helping me out, and in some cases it is actually true. I mean, when I was broke, I wanted to buy a $400 juicer, and I did use buy now, pay later financing. It has its appropriate moments, but we can't overdo it, right? We can't overdo it. Okay. I actually bought it from QVC.com, and this is like in the mid 2010s. And I don't regret it. It was a good financing purchase for me because I didn't have $400 up front. But on a mass scale, it's kind of wrong, right? So if that makes sense, when used appropriately for the consumer, it could be a good tool. But listen, if you're making $2.3 billion off of it, and there's nothing wrong with making a lot of money. Like, don't get me wrong. What I'm saying is that you're making a lot of money from people who are struggling. That's the issue, right? Like you don't like anytime you sell a product or service, you want to make sure it's like a blessing. Like if I sell you a 10 grand product, I want you to, hopefully the knowledge that you attain from that 10 grand product will allow you to make, 3 to 20 or 100 times more than whatever I sold you, right? Okay, so let's go ahead and enough rambling here. So this is 23 months to pay out these 3 credit cards, and luckily we have this loan calculator, right? So all we got to do, and I keep forgetting to reset this part. All right, all we got to do is put in the current month, and then this cool calculator will tell you the original balance. You just put in the interest rate, loan term, and it'll spit out a payment. So you see this formula. It's not as complicated as it looks, but if you just learn a little bit of Excel, it will spit out a payment amount, and then it'll spell out what they call the future value or the current balance, latest balance. So what you gotta do is just put in the month here, 23, 23, 23, and then it'll tell you the current balance here, and then the cash flow index. So CFI just means cash flow index. So what I recommend you to do to figure it out, or what cash flow index is, just use Google. Just use Google. Basically, it's just a formula that tells you um, what is the ranking of your loan you should pay off, right? So if I go in here, I'm sorry, if I go in here, this low number means I should pay it off quickly because it's sucking up a lot of my cash flow. What I mean by that, like, do you want to pay 13 grand? Would you rather pay 13 grand to get $390 back in cash flow or 28 grand to get 368? It's a no-brainer to get the 13 grand and get the 390 rather than the 28 grand and then get the 360. Okay? So, let me go ahead and do this, and we're going to move this uh, auto loan into that line of credit. So what we're going to do, because this is the remaining balance right here, right? And now what we do is we just move, whoopsie, what am I doing? We're going to move this 13 grand into that line of credit. So 13145.16, right? 13145. 13145.16, okay? And then now we got to update our cash flow. Okay, so if I do 0 right here, then now the cash flow is $2,800. $2,800 right here. And then so minus 2867.16. Okay, and now that's our new cash flow. And then now I just copy and paste. And well, blam, in about a couple of months, about 5 months, this is now, it's over, right? So what does that even mean, it's over? I don't even know. All right, so where is it? All right, okay. So in 28 months, we paid off this auto loan. So now let's go ahead and update the figures. So this will be 28 months, and then it's 52, so it's 72K. And then now we have a student loan. The student loan is going to be, now this is going to be 28, 28. Again, I'm not sure if I should move this entire student loan into the line of credit, because take a look at this cash flow index. Hold on, did I do this wrong? Let me just see. No, I did it right. Okay, so usually it says below 50 you want to pay off, right? So they have like 0 to 50, 50 to 100, over 100. So let me just go here. But because of the relatively low amount, I still might do it, but I definitely would not do the mortgage, right? And in real life, I probably would just do what we call the chunking method, which is just do it in little pieces, which I'll demonstrate with the mortgage, but let's just make it the demonstration simple for now. So let's just go ahead and move this loan into that line of credit. So this is going to be plus 26989.9. Okay. And then now what we got to do is add our student loan to the cash flow. So this is now 0. Okay. And then this is our new cash flow, which is more than 3 grand, which is pretty good, right? Pretty sweet. So now let's copy and paste this. Let's update our cash flow to be 3235.1. Is it 19? I think it's 19 because I got a round. Let me just check up there. Yeah, 19. All right. So 19. And then now let's go ahead. Whoopsie. All right. So now let's go ahead and copy this. We got our new cash flow. And then now it's paid off in 38 months. So now the last thing we got is that mortgage. Okay, so the mortgage is completely gone. So what was it? Took us, yeah, 10 months to pay off that student loan. Not bad, right? Student loan's supposed to be 10 years. They say it's the gift that keeps on giving, I guess, because so many people go on repayment programs because they got issues with their cash flow. But here's the thing about like those income-based repayment programs, because the payment amount is so low, it's actually less than the interest that accrues. There's probably for most people, what happens is that the balance of the student loan actually increases, right? Because of the payment that's actually lower than the interest accrued. So therefore, it's not amortizing, right? Meaning that's not dying off. Okay. So if you don't know what the definition of amortized loan means, it means a loan that actually dies off over time. Um, but most people are kind of get confused by that. So it's still calculated by simple interest, but the what makes it advertising is that if you look at your next statement, even if it goes down a penny, it's still amortizing because the balance is going down. Now, well, I'll probably go over that in another video. All right, 72 plus 33. All right, so 105K. So, all right, so now let's just do this. 38 months. How long? And look at that. So, cash flow index is very high, meaning it's very inefficient loan, meaning that if I pay this off, I only get $1,200 back in my cash flow, but we still do want to pay it off because if we make this go to the full term, and let me go here, so do $300,000 at 3%, you'll notice that you're paying $155,000 interest for this $300,000 loan. So interest is the trade-off for, let's say, not taking up so much cash flow. I don't know if that's the best way to put it. So let's just do this. How much of the principal was paid off? Right? Probably need to make a column for paid off principal. It's 300 minus 279. Okay. So that would be mean 21K, right? 21K. And what is this? 21K. Let me bold it. Why is the font so much bigger? All right, well, whatever. So 21, so 21K was paid, principal was paid off, okay? And this took us 38 months. So now let's just do this. And again, I don't recommend actually doing it this way, but I just want to make you a quick comparison. If we moved at this point 21K into that line of credit, right? This is what we call the chunking method, just moving parts of the loan into loan into the line of credit in little pieces. How long would it take us? Okay, so it's 21, not 210. Oh geez. 21 grand. Let's keep doing. So we did that in 45 minus 38. That's about 7 months. So something that took us 38 months, we were able to do in 7. And so it's 38 divided by 7, right? So we could have actually done this 5 times, like take off 21K. So I know, and hopefully I'm not confusing you all with this. 5 times. Wait a minute. I'm getting confused now. So basically, oh no, it's 21. It's 21 times this. Okay. So we could have taken off 114K in 38 months if this was our starting cash flow. About approximately, right? But we only took off 21K in 38 months. Isn't that sad? That's really sad. So basically, the whole point of this is that we just kind of rinse and repeat the process. We do something called chunking or chopping the loan into pieces and then just doing it over and over again. So let me go ahead and open this up, right? So I'm going to open up the velocity banking calculator so you can easily see a round in your face number of how long it'll take the loan to pay off. Give me one moment. Okay, so basically I got this velocity banking calculator where I just pre-filled the information provided by Renatus because I'm a Renatus student and this is where I originally learned velocity banking from. And here you can see it's going to take 5.7 years. Now, some people get like so obsessed with this chunk amount, but it really doesn't matter because what the most important thing is the number between here and here, right? And the other important thing is that we don't put the entire loan into the line of credit or replace it with the first lien HELOC. Because let's say I replace this with the first lien HELOC, 279,405.1, right? The interest saved is only, so it takes 6.8 years and I only save 43K, whereas if I just chunk a small amount, which I mean just as a um, rule of thumb, I mean just use like a paycheck, right? $7,000, 5.7 years and 26 grand. And if I move, like let's say move this, change it up to whoopsie, higher and higher amounts, you don't get higher savings. I think that's a misconception. But let's say it's 13 grand, and you see that I pay a little bit more, right? So just do a small amount, right? You get the same benefits and savings as doing extra payments, but you're actually in control of your money. And it's easy, right? One of the reasons why people can't pay off their loans fast is because a loan is a one-way street. And if you directly overpay your loan, it actually ruins the cash flow for most people. But with the line of credit, it's so much easier. Okay, so as you can see here, we only pay 26 grand of interest, 5.7 years. So we just do this right here. And then, so this is like 38 divided by 12 plus 5.7. Okay, so that's 8.87 years, and we are 405K debt free. All right, sweet, sweet, awesome, awesome. Okay, all right. So yeah, that's it for today. Again, remember, it's all about the mindset, or most of it's about the mindset, because what happens is a lot of people who make a lot of good money, like a lot of people don't understand this. If you make good money, you're the best candidate for a bank if you're stupid and you don't know how to manage it. Like people think banks like to target poor people. That's actually not true. Banks avoid poor people like the plague. They like to target rich people who aren't good with money. And so a lot of you actually associate, oh, being rich or making a lot of income means you are good with money. That's actually not true. That's why lottery winners always end up broke or possibly dead in like a couple of years. Because there's no money management skill that was learned throughout the years, right? It's just, best way to ruin someone's life is just let them win the lottery. And that's why I say, hey, if you're broke right now, learn the money management skills. So when you get the money, right? When you get the money, you don't end up here, you end up here. And actually, what's going to happen is that this is now going to go to zero. And we're going to have rich people problems, which means that after every single month, we're going to have $5,400 in our savings account. Month one, month two, next year, 4,500. I mean, and then now we're going to have rich people problems. Like, you know what rich people problems is? Is like when you have $100,000 in your savings account, and you're like, what do I do with it? Like, I'm losing it to inflation. I know that it's like a losing battle. This is why it's much easier to raise money from rich people than it is poor people. Even the government knows that raising money from poor people is a bad idea, which is why they have all these laws about accredited investors. And you probably have to do a lot more due diligence and all this stuff. Or I don't even know because I've never raised money, to be honest, because I used to banks money. But they know it causes a lot more problems, which is why they have the title of accredited investor of who can invest in your little fund or syndication or whatever, right? All right, so that's it for today. So, yeah, remember, a lot of people lie to you, and that's why all of this is so confusing, and that's why you got to have a good education and foundation when you go through all of this. And I'm going to tell you this: you're certainly not going to learn this in college, right? What does college teach you? It's pretty disappointing when you watch like college students nowadays, like what they're focused on. And I was like, well, don't you care about making a little bit of money? And they all think that we're going to live in some sort of paradise where you do nothing and somehow people will give you a job. But in order to get that job, someone has to sell a good or service in the marketplace and sell a ton of it so that you can have your job, right? Okay. All right. Well, that's it for today. This is Korean Atlanta Mentorship. Have a great day, and we'll speak next time.